Hey everybody, Bruce here. Today's what, March 13th, and unfortunately, our Board of Realtors has not issued the numbers coming out of February just yet. They are trying to collect some data from showing time, and it isn't quite ready. Anyway, I wanted to take a quick second to update you on what we gleaned, what we learned from our annual Keller Williams convention. All right, we spent some time with our leadership and learned a lot about where we were, where we're going. So I figured I'd share with you some of the national numbers and the state of our economy. So bear with me. I'm going to share my screen. There it is, coming up. Boom, there we are. So this was the vision speech that Gary Keller gives us. And I'm going to go through this kind of rapid fire. If you have any questions, call me. All right, here we go. So these are the numbers that drive U.S. real estate. We're looking at home sales. So you can kind of see, from 21 to 22, we went from 6.1 million transactions down to 5 million. The only other time we had that steep a decline was back in '06 to '07. And we know what happened then, didn't we? It was called the Great Recession. Are we headed into one? Not at all. Here we go. So if we take a look and break that down into a more monthly, seasonally adjusted, you can kind of see we just slowed down every month of last year in 22. What's going to happen in 23? Home prices. This has really been the story. You can kind of see, post recession, in other words, '06, '07, '08, there was a giant pullback. And then literally from like 2010, 2011, straight all the way through 20, it has been like this parallel line to that green line. That's the long term average, if you will, long term trend for real estate, which typically appraises around 4% a year. But we had something called a pandemic show up, and all hell went crazy, right? The government bought bonds and securities, mortgage backed securities. They dropped interest rates. People learned they didn't have to live in a big city to go to the job, and they decided to move, et cetera, et cetera, et cetera. Anyway, you can see that we caught back up in 20, 21, 22, and made up for the quote lost decade. We're not trending too far above the trend line. And thoughts are for 23 that we're going to see a slight pullback or just stay flat, which is all good. All right, if you look at this and if you actually squint, you can see that the purple line, which represents 22, went up in June and then kind of started to scale back. Well, what happened in June, July last year? That's right. The Fed went nuts with respect to interest rates. Home prices, again, if we annualize it and spread it out, you can kind of see how we lost a lot of value in the recession, 6, 7, 8, 9. And then it was a slow climb up and out. And most recently, in the 20 to 22 period, we're up 12.49%. Even if we pull back a little in 23, if you still look at that 4-year window, you're still up 9.1%. Still not a bad thing. Inventory, right? That's the real discussion. We don't have enough homes. Okay. Sellers are not coming back to the market right now. Why? Because they're sitting on a 2.75, 3.0 interest rate and they don't want to buy into a 7. Totally understandable. However, life happens and we got to do and make certain changes. Again, monthly, you can kind of see here, 22 inventory is flat. It kind of, there's some seasonality to this, and we're not seeing that seasonality. June, July, August, September, October, 3.2, 3.1, 3.3. It's been flat. Usually it decreases during those latter months. Mortgage rates, again, long-term historical average, 72 to 20, 7.81%. What are interest rates today? My son just got an interest rate. He was at 5.99. Again, below the long-term average. The rates are not ugly. If you were in 1982, you'd be throwing up right now. You would no, I take that back. You would be rejoicing. While your friend's getting 16%, here you are locking in something at 7. That's a good thing. All right. If you shorten the window a little bit, look from 1990 to 1920, you're at 5.97. Gosh, we're at 5.99, 6.0 now. Not that far off a historical average. Okay. Again, this is just looking at it monthly. Unemployment. This is where we really differentiate ourselves from, 12, 13 years ago. Back in '07, '08, unemployment all of a sudden shot through the roof. Not, and we had an anomaly, if you will, here in the COVID years, right? In 19, we were at 3.7 annual unemployment rate, which is a historic low. Okay. And then, of course, COVID hit and it shot through the roof, but we recovered so dramatically fast. This was historic. I mean, you can kind of see here, April 20 shot through the roof at 14.7. Unprecedented. But what industries were impacted? Think about it. Right? This was travel, destination, the Disneys of the world, cruise ships, restaurants, right? The bankers were still working, the steel workers were still making product. I mean, again, we got back to work really, really fast. And you can kind of see, at 3.5 in December of 22, that is full employment. Inflation's been the story, and the Fed's a hawk. They're going after it like a dog with a bone. Okay, they want it back down at 2%. They're shooting for that in 24. So they're going to continue to go after it. And we just got to deal with it. This is interesting. When you look at it from a historical perspective, again, if you bought a car, gallon of gas, a house back in 1989, and you had a mortgage and it was running you $678 a month, when you adjust that for inflation, what would it be today? 1675? Well, gosh, in 22, you would have had a 1722 payment. It's only 2.81% above the average, above that, adjusted for inflation. Okay, so we're right where we're supposed to be. And guess what? When's the best time to plant a tree? An old Chinese proverb. It's either 20 years ago or today. This example is showing you should I own or should I continue to rent a home? Well, guess what the interest rate is if you rent? It's 100%. You get nothing. Okay. If you buy a house 10 years ago and you own it, you see after year 3, you're breaking even. In other words, if I was going to rent a house, invest the difference, in 10 years, my net worth is going to be 106,229. Well, if you own a home, you're growing wealth through what? Paying down the principal and increased home values. Okay. You would literally have double that in net worth. It's a great vehicle. Call me. Thanks.